Hey everybody, how's it going? It's Russell here, and if you've been paying attention to Canadian real estate over the past couple of years, you probably already know that things have gotten a little bit insane. Take a look at this. This is March 2020. $581,000 was the average real estate price in Canada, and now, 2 years later, it's $887,000. You see here projected declines. We're going to get into that in just a minute. But now we're starting to see a turn with prices starting to decline. Just take a look at this from February 2022 to March 2022. Over that 1 month, we saw a decrease in the average home sale price of 2.5%, roughly 2.5%. Now, we still see this over 10% gain year over year from March last year to March of this year, but we're starting to see this direction at the very least turn. And I think when we get April's data, we're going to see this sort of amplified. So in today's video, we're going to go over exactly why this is happening, if it's likely to continue, if there's any ways that you personally can take advantage of this, as well as the surprising place that I think that this could all end up down the road long term. But before we do, make sure to subscribe to the channel if you haven't already done so, and check out the links in the description. You can get $50 for free when you sign up for Wealth Simple and $25 for free when you buy your first cryptocurrency with Newton. But now that you've taken a look at this, let's dive into exactly why this is happening and if it's going to continue or even speed up going forward. And well, it all starts with the inflation rate. Now I'll explain how this ties back to real estate very soon, but take a look at this. We had the most recent reading of CPI inflation, that's Consumer Price Index, at 6.7%, the highest that it goes back on this chart. I actually had to go to a different chart to see the last time we had prices this high, and we see this peak back here in 1981 of 12.47% as the inflation rate. But obviously it's an unprecedented time when it comes to how dramatically and how quickly prices are rising in Canada. This is all really starting to freak out the Bank of Canada, which is the central bank that controls interest rates or has the most control over interest rates of any entity in Canada. Let's listen in on this hearing that was recently held by the Finance Committee in the Government of Canada and hear what Tiff Macklem, the Governor of the Bank of Canada, had to say, and he does not mince his words.
We are committed to using our policy interest rate to return inflation to target, and we will do so forcefully if needed. Increases in the bank's policy rate raise the interest rates on business loans, consumer loans, and mortgage loans, and they increase the return on savings. We've been clear that Canadians should expect a rising path for interest rates, but seeing their mortgage payments and other borrowing costs increase can be worrying. We will be assessing the impacts of higher interest rates on the economy carefully.
The whole point of the Bank of Canada, or their mandate, is to keep inflation in check. Now, for them, that means keeping inflation between 1% and 3%. That's their band of acceptable inflation. And right now, we're at 6.7%, so they're a little bit upset about this, and they want to change that. Now, by raising interest rates, the Bank of Canada thinks, hey, well, if we raise interest rates, well, it's more expensive to borrow money. You have to pay more interest on it, and maybe people can actually make more in their savings with a higher interest rate. So if we do both of those things, we expect that Canadians will spend less money. Now, this is an attack on the demand side of the economy, saying that, hey, maybe more people won't go out and spend this money, and as a result, we won't see as drastic price increases because there's simply not the demand to support those higher prices. When the Bank of Canada raises their interest rate, well, that gets passed on to people who are looking to take out money from banks or other lenders to buy homes. These are mortgages, right? And now, usually when we see an increase in interest rates, every 1% that interest rates go up, we typically see a 10% decrease in terms of the home sales price. Now, this is a result of how people qualify for mortgages. If you have a higher interest rate, you can qualify for less home. As a result, there's less demand in the market for those homes, and on average, those sale prices go down as a result of that lessened demand. And recently, Desjardins reported that they expected to see interest rates rise all the way up to a whopping 7% by next year. Now, right now, rates are around 3.5%, which means we could have another 3.5% to go before we reach what Desjardins is expecting here. Now, following along with the sort of rule of thumb that I just went over before, every 1% increase in interest rates results in a 10% decrease in average house price. Well, that means that we have 3.5% to go to get to that 7%, which means 35% potential reduction in real estate prices coming if you follow this rule of thumb. Now, of course, that doesn't cover absolutely every single element of what makes up the Canadian real estate market, but it does provide us a potential route that we could see going forward. At this point, some of you might be thinking, okay, well, this actually doesn't sound too awful. I don't currently have a home, but I want one. So seeing prices go down means that I could potentially buy one, right? Well, that might not be the case as a result of how people qualify for mortgages, which everyone or most people definitely need in order to purchase their first home. Let me show you what I'm talking about. We're going to compare what you could qualify for now versus if we saw a 30% decrease in real estate prices. So we're going to take this benchmark price right here, currently $887,000, and I've sort of plugged that in over here to an amortization calculator. This just gives us the amount that you would have to pay monthly if you were to get a mortgage. So based on that benchmark amount and a 20% down payment, that would be $177,000. We need a $710,000 mortgage here over 25 years, and we're going to use the interest rate of 3% here. Now, that results in a monthly payment of $3,366. Now, we're going to use another rule of thumb, and that is that the amount that you pay monthly on your mortgage shouldn't be more than a third of your income. Of course, that's sort of like another loose rule of thumb here, but you won't be able to qualify for a mortgage unless your income is at least 3 times as high as your monthly payment or your average payment over the course of the year. If we were to multiply this number by 3, that gets us to roughly $10,000 per month that you would need to make in order to qualify for this average benchmark home. On a yearly basis, of course, that's $120,000 in order to qualify for the home. But now let's compare what would happen if we actually saw a decrease in home prices by 30% as a result of a raising interest rate. And we're going to find out whether or not, okay, if it's better or worse to buy now or to sort of wait for this decline with higher interest rates. If we go with this aggressive potential decline of 30%, well, we'd see the average benchmark price going down to $620,000 roughly. Now that would result in a $124,000 down payment, meaning that you'd actually have a $496,000 mortgage. Now, I know we said that interest rates could spike up to 7%, but let's be a little bit more conservative with our numbers. If interest rates were only at 5% when we saw this, a 30% decrease, well, here's the result of your monthly payment. You'd be paying around $2,899. Now, if you, again, multiply this by 3 to see what your monthly income would need to be to qualify, you'd end up around $8,690 per month, and that's around roughly $104,000 per year. So you'd be able to sort of qualify for the average benchmark home a little bit more easily in this unique situation. But this is an example of what you would need to calculate to determine, hey, is it important for me to sort of lock in a low interest rate now, even though home prices might be a little bit higher than they will be in a few months, 6 months, or a year from now? Or do I sort of need to take into consideration the fact that interest rates could be far higher? But now we get into the question of where I see this going long term, and I think it might not be the traditional view of how this is going to end up. Right now, I think we're going to continue to see inflation rise for the next little while, and as a result, the Bank of Canada will continue to hike interest rates higher and higher and higher as a way to combat that inflation. But the big pressing question here is, how far can the Bank of Canada raise interest rates before they break something extremely important in the economy? Right now, household debt is at the highest rate it's ever been, and if we see interest rates increase, that means that on average, that debt is more expensive, right? The interest payments that you have to make will be more expensive as interest rates go up, of course. Additionally, there are many individuals in Canada who are relying on their home prices to fund their lives, either through refinancing, a cash-out refi, where you can get this money from the equity in your home and sort of support your life on that, or maybe you're getting closer to retirement and some individuals are depending on the sale of their home in order to fund their retirement. But regardless of what the cause is, I do think that at some point, if we continue to raise interest rates dramatically, like the Bank of Canada is suggesting they'll do, that something is bound to break. Now, if the economy takes a turn for the worse, the Bank of Canada will be forced to respond. And how are they going to do that? Well, they're certainly not going to keep increasing interest rates. No, I think they'll go back to what they did at the beginning of the pandemic, the last time we saw this sort of mass economic crisis. And what they did then was they lowered interest rates, the opposite, and they printed a bunch of money through a program called quantitative easing. And these are the two elements, the lower interest rates and the quantitative easing, that I personally believe result resulted in the huge housing boom we've seen over the past 2 years. But again, the big question is how far can the Bank of Canada go before something breaks? But now we need to get into how you might be able to personally use some of this information to benefit yourself. Well, if you're someone who is maybe waiting on the sidelines in the housing market, I think it's very important for you to do the calculation that we did in the middle of this video, where we talked about, okay, you got to weigh the benefits of trying to buy a home now versus later with these different sort of interest rate possibilities of where we could see interest rates and house prices in the future. And as I always recommend, if you do end up buying a home, I always recommend picking up something that needs a little bit of cosmetic renovations, need new paint, needs new floors. You can often get a property for below market price as a result of taking a home that needs a little bit of work. And additionally, look out for properties that you could potentially get rental income from while you're living in the property. This is called a house hack. Finding a property where maybe there's a basement unit that you can rent out or put on Airbnb, or maybe even just rent out additional rooms to roommates. Finding a way to get rental income from your property means that even if we take a turn for the worse in the economy, well, you're still going to be able to afford your mortgage payments, and actually the equity is going to be sort of building up in your property. Even though you're not paying for the entirety of the mortgage payment, you're getting some of that rental income to cover it. If you find a property that needs these cosmetic repairs and might be able to actually work as a house hack, you might be able to get a good deal on it right now, as sellers are a little bit fearful of this potentially turning market. After 2 years of a strong seller's market, we could be seeing a shift here, and that means that buyers might be able to benefit from it. But it's certainly going to be interesting to watch how this all plays out. Let me know what you think is going to happen. What have I missed here? Let me know down in the comments. I read every single one, and I try to get back to as many as I possibly can. And if you haven't already, subscribe to the channel and check out those links in the description. $50 with Wealthsimple when you sign up, $25 with Newton when you sign up, and when you do so, it supports the channel directly, so I appreciate that. But with all of that said, thanks so much for watching, everybody. I really hope this video has helped you out at least a little bit, and I'll see you next time.